Okay, good morning everyone. We're going to start our webinar now, 11:15 webinar. This is Richard, analyst for transport and logistics, and I also cover the industrial REITs. This is our usual disclaimer. Okay, we'll start with the week ahead. So this week, the Fed will be meeting on Wednesday, and we will anticipate the announcement of their interest rates. So we think that there will be a 50% chance of a 25 basis point hike. Other things to note will be on Wednesday, UK will be having their Bank of England minutes as well. Friday this week, USA having quadruple witching, so look out for market volatility. Okay, next, keeping things in perspective. So you will hear a lot of news about interest rates this week. US Federal Reserve will meet on Tuesday and make the announcement on Wednesday whether or not they will raise their benchmark overnight rate from 0. Now you know that interest rates now are low, near 0. So even a 25 basis point hike is actually very low and is sustainable. It's actually good because the zero interest rates were an emergency measure meant to flood the market with liquidity and to jumpstart the economy. But the economy has improved already, and so it's natural that interest rates will have to rise. Okay, now I'm moving on to the main part of the presentation, which is on Soilbuild REIT. We initiated coverage on Soilbuild REIT today. Okay, this is a REIT snapshot. It closed at 80 cents last week on Friday, and we have a target price of 99.5 cents with a buy rating. Forecasted DPU is 6.56 cents compared to last year. Full year DPU of 6.19 cents. So if you compare 6.56 with 80 cents, it's actually about 8.2% yield. 52-week range was 76 cents to 81.5 cents. Market cap is about 650 million. Okay, so for investment thesis for Soilbuild, we'll start from a top down. What we see is a decentralization of commercial activities outside of the city. So a lot of corporations are moving their non-customer facing operations and functions outside of the central business district to business parks. And so business parks, they are in fact a direct substitute to commercial space. The buildings in the business parks are comparable to the normal buildings in the city. They have a pantry, lift, toilets, so the amenities and physical specifications are all the same. But the thing about business park space is that the rent is lower. So moving on to the third point on the page, we look at fourth quarter median rents. Business central area commercial space was going for about $10, but if you compare a business park space, it ranged between $3.20 and $6. And for perspective, against other industrial properties, which are factory and warehouses, they typically go for under $2 a month. The next thing about business park space is that it is scarce compared to the rest of the industrial space. So you look at the pie chart on the right, business park space takes up only 4% of the total available industrial land. The bulk of industrial space in Singapore is actually allocated for factory use. Next point, there's a limited supply pipeline for business park space. If you look at this is for 2015 and this for 2016. So business park space, the upcoming supply pipeline is the green bar, and So they make up 7.7% and 8.8% of the total supply of industrial space for 2015 and 2016. So lastly, we'll go on to why Soilbuild REIT. So Soilbuild REIT has a significant exposure to business park space. 39% of it is business park space by valuation. You see that in this bar chart here. One thing to point out is that for AIMS AMP Capital, they also have a business park in Australia, and if you add Australia in, then this 7% will actually be higher, around 20%, but we have taken that out so that this will be representative of the individual REIT exposures to business park space specifically in Singapore. So Soilbuild has got two business park properties. One is Solaris, which is located at One North, and the other is called Atrium at Changi Business Park. As I showed earlier in an earlier slide, business park rent ranges from $3.20 to $6. So you can see One North is 4 to 6, and Changi Business Park is around 4 to 4.50. So Soilbuild's business park properties are a bit more on the higher end of the quality, and so they command the middle and upper range of the rent spectrum for business park space in Singapore. And the second point for Soilbuild REIT is that it has the longest remaining land lease expiry among all the industrial REITs in Singapore. They have a land lease of 48.6 years, which is longer than the typical 30 years from the government land sales. And actually, there's a trend now of the land lease shortening. If you go to the JTC website, you can see that it's shortening to 25 and some even 20 years lease now. This chart here shows the land lease for the industrial REITs. So as of fourth quarter, for Soilbuild, it had 10 properties. It consists of 2 business parks, which is this, Solaris and Atrium, and 2 multi-user factories, which is a Tuas Connection here and the West Park Biz Central. And there's 6 single-user factories which are on master lease, which is KTL Offshore, BK Marine, SpeedyTech, NK Ingredients, Koch Printers, and Thales Marine. Thales Marine, KTL Offshore, and SpeedyTech were acquired from third parties in FY14. This chart shows is a snapshot of their portfolio, and so what you should take note here is the 48.6 years, which is the longest remaining land lease for industrial as REITs. Soilbuild REIT outlines a 3-pronged growth strategy, so I'll go into the 3 of them briefly one by one. So firstly is the stable organic growth through inbuilt rental escalation of master leases. So they have 7 master leases here. And you can see that the master lease are all very long, ranging from 5 years to 15 years, and there's rental escalation for the master lease either on an annual basis or a biannual basis, depending on which property. The second growth strategy is upside potential from multi-tenanted properties. How this works is that when the tenant lease expires, and then if they renew it, if the market rate is higher than the passing rent, then there will be positive rental reversion. So they currently have 3 properties which are on multi-tenant lease, which is West Park Biz Central, Atrium, and Tuas Connection. So how you read these charts is that the yellow bars represent the percentage of that particular property that has tenancy that's expiring. The red dots are the passing rent for those leases, and the blue line or the blue band is the current range for the market rate of rent. So if you see that the red dots are below the blue band, then there's potential for positive rental reversion. Lastly is inorganic growth through acquisitions. So as I mentioned earlier, they had 3 acquisitions in FY14. These are the 3, which is Thales Marine, KTL Offshore, and Speedy Tech. For their sponsor, the sponsor for Soilbuild REIT is Soilbuild Group Holdings. They are going to have a TOP expected in the first quarter of this year for this property in Bukit Batok. So it also represents a acquisition opportunity for Soilbuild REIT. Soilbuild REIT enjoys a dominant position among the industrial S-REITs. As mentioned earlier, they have the longest land lease, and it's longer than the typical JTC 30-year land lease. You can see here, this table shows the land lease for the industrial S-REITs, and Soilbuild REIT is the only industrial S-REIT with 100% occupancy in their portfolio, so all the properties are fully utilized. Going quickly through this is their lease expiry profile. So they have a WALE of about four years, and so for this year 2015 they have about 23% of potential lease expiring, and 17% next year. So this is actually quite manageable for them to renew their leases. They also have a staggered debt profile. So current debt 374 million, and representing a 35% gearing, and with an implied 80 million debt headroom. So their weighted average debt maturity is 2.1 years. You can see that their debt actually is staggered almost equally for the next 4 years, and they have no more than 95 million of debt maturing each year. Now we look at their peer relative valuation. So they have, we think that they have 3 closest peers, which are Ascendus REIT, Mapletree Industrial Trust, and Viva Industrial Trust. This on the basis of their exposure to business park space. So what we see is that Soilbuild REIT has a higher yield than the peer average. Soilbuild REIT has a yield of 7.9, historical 7.9 compared to the average of 7.5, and we think that there's still room for yield compression. Soilbuild is currently priced at 1 times NAV, and which is lower than the larger market capitalized peers, which have a shorter land lease expiry and have lower yield. So we think that for Soilbuild, on the basis that they have the longest land lease, they certainly deserve a premium to their NAV. So the investment merits for Soilbuild REIT is its specific exposure to business park space. As we explained, there's this trend for commercial activities decentralizing outside of the city, and so there will be demand for business park space. Soilbuild has the longest land lease expiry among the industrial S-REITs, which is even longer than what JTC gives today typically, and the trend is also going downwards, approaching 20 years as well. They have a distinct competitive advantage of having a sponsor from the construction sector. Their sponsor is Soilbuild Group Holdings, and there's a strong alignment of interest between REIT manager and unit holders, because the base fee for the REIT manager is pegged to distributable income, and the performance fee is pegged to DPU growth. This is unlike most of the other industrial S-REITs, where the base fee is pegged to portfolio value and performance fee is pegged to NPI. There's also an attractive dividend yield of about 8.2%. So as usual, the risk factors is typically the same for almost all the REITs. First one is the refinancing risk, because REITs are geared, so the ability to refinance their debt is paramount. Macroeconomic risk, which affects every other business as well. Rental reversion and occupancy risk. So what we see is that there actually is some near-term headwinds in the large supply of industrial space. in 2015 and 2016, but we are specifically targeting the business park space where we see that there is demand and the supply that, as we shown you, there's only 4% of business park space among all the industrial space, and only about 7 to 8% of the new space is going to business park space. Regulatory risk, so there may be change in rules in land use and tenants, and this could affect the ease of securing new tenants. And as like any other REIT as well, there will be unit holder dilution and possibly value destruction if the manager does not make prudent acquisitions. But we think that this shouldn't be the case for Soilbuild REIT, as explained in the previous slide, that there's actually a strong alignment of interest with the REIT manager and with unit holders. So last week, this is an update on acquisition. Last week, Soilbuild REIT actually announced that they are in the process of acquiring another property. So that would be their 11th property in the portfolio. So the total acquisition cost is actually 98 million. It's for an integrated seafront facility. It is a unique facility with a dormitory, office block, and a jetty, and it is the only alternative to the Loyang offshore supply base. The transaction is actually a sale and lease back. So the existing occupant is going to lease back the property for another 15 years. And so the rental will be 7.87 million per year, and there will be a 2.25% escalation from the third year onwards. With this new acquisition, the WALE for Soilbuild REIT will become the highest among the industrial REITs at 5.4 years. Okay, so why we think that Soilbuild really deserves a premium to NAV? Soilbuild is now trading at 1x book, and we think that there's still room for yield compression on account of these 3 points where they are far superior to the rest of the other REITs. Firstly, is their longest land lease expiry, and then they are the only REIT to have 100% portfolio occupancy. They have a business park space at One North. The building is called Solaris. That building is under a master lease, but even that building, which is on a master lease, has 100% underlying occupancy as well. And lastly, they now have the longest WALE among the industrial REITs. So to summarize, I give you 5 points: where, who, why, when, and what. So where there's a secular trend of decentralization of commercial activities outside of the city. So who will benefit? And that will be Soilbuild Business Space REIT. Why? It's because they have a portfolio with significant exposure to business park properties. For the time factor on when, so they have the longest land lease to expiry and the longest WALE among the industrial REITs. So we have a buy rating on Soilbuild REIT with a DDM valuation of 99.5 cents. So we've come to the end of the presentation, and we look forward to hearing your questions. Yeah, okay. First, there's a question: what is WALE? Okay. WALE stands for weighted average lease expiry. So if you look at this page, the WALE by NLA is 4 years, and by gross rental income is 3.9 years. There's a question on Soilbuild's portfolio, the makeup, like business park and industrial. Yes, but as you can see, the thing is that if you want a targeted investment in business park space, then you would have to take up Soilbuild REIT, as they have one of the largest proportion of business park space. There's a question on Viva, how to compare Viva with Soilbuild. Okay, so one thing you need to know about Viva is and Soilbuild. None of Soilbuild's properties are on rental support, whereas for Viva, I think at least 3 of them are on rental support. The 2 that they acquired, the Jackson buildings last year, as well as at least one of their business park space, which is located at Chai Chi, the Techno Park at Chai Chi. So the thing is that these properties, they are on rental support, and they do not have 100% occupancy. So when the rental support ends, one of the risks that you may face is that there will be a sudden drop in the DPU. Yeah, there's some questions relating to interest rates and REITs. So we have the opinion that actually interest rates do reflect a strong economy, and the REITs are able to ride on that as well through higher rents, and that will result in positive rental reversions. Yeah, there's a question about 99 cents target price and the properties being 100% occupied. So let's look at this again. So if you go with a 99 cents target price and based on a 80 cents book, you're actually looking at a target price of about 1.2 times as well, which is actually on par with the 2 larger market capitalized peers. And these peers have a lower yield, and they do not have the same superior factors as Soilbuild REIT, such as the longest WALE and the longest land lease expiry. Okay, there's a question on inorganic growth. Okay, so for companies, there's usually, for companies, there's organic growth, inorganic growth. So organic growth will be something like expanding your product line or increasing your sales channel or selling more of your existing goods to more customers. So for the REIT, their organic growth will come through rental escalation of master leases or positive rental reversion from lease expiries. And then if in a buoyant rental market, so the new rent that the tenant will sign up on will be higher than the rent that the tenant was. For inorganic growth, it is through acquisitions of new properties. So what has happened for Soilbuild REIT is that in the last FY, they actually acquired 3 properties, and these 3 properties are on master leases. There's a question on the perspective of the rest of Soilbuild's portfolio, which are in factories. Yeah, but if you look at that, those, okay, sorry, let me go back to the slide. This one, these on the left side, the first 6 are all the single user factories, so they are on the master lease, and so they are not affected by the new supply of factory space because they have long leases. You can see it's range from 7 to 15 years, and these will tide through the next 2 years of 2015 and 2016, where there's the supply of new industrial space. So these properties are not affected by that. I will wait a little while more for any further questions. Okay, no further questions. We'll end the webinar here. See you again next week.